So, have you ever had this experience where you have a really good runner and you say, hey, I should take some profits on this because this trade is doing really well and there's probably not a whole lot left in this? And then, as soon as you get out of the trade, it ends up going twice as far as you expected and you missed out on half of the profits? Well, I think we have something that can help you with that. Hi, I'm Speculator Seth, and before we get into anything else, credit where credit is due. This is not a concept that I came up with on my own. This is something that we were really keyed into by Gary Rich, who is a member of our chat. We live stream every day from 8:20 to 10:30 Eastern time, and we have the same group of guys almost every day, really dedicated group of guys, and I really think a lot of them are much better traders than myself, and Gary Rich being one of them. So, if you want to thank somebody, go into the comments right now and say thank you, Gary Rich, because he's the one responsible for this. And I have to say, when he first shared it with us and I actually programmed it up and started looking at a chart of it and everything else like that, I was really quite surprised. And I said, Gary, we should stop talking about this because this seems like an edge that's too good to be to be sharing. But he insisted, no, you should use it and you should share it and make as much use of it as you can. So that's what we've been doing. And, it makes a lot of sense why, because really is a tool that I think should be one of your main toolboxes, because this is volatility. And volatility is such a key part of how the market works. There's a reason why professional traders pay a lot of attention to the VIX. So just really briefly, what are we talking about? What we're doing is we're using implied volatility. Implied volatility is basically how much the options are saying the index should move for that day, right? So if you're buying an option, in order to make money on that option, the price of the underlying stock has to go further than what you paid for the option, right? And vice versa, if you're selling it, you want it to stay, below that strike price, right? Well, they take all of this information about what strike prices people are buying and how they're pricing it and puts versus calls and everything, and you get the volatility index. So the volatility index, we take that opening of VIX number and we divide it by 16, and that is the percentage change that we expect to have on the S&P 500. Now, I want to make it really clear that that's implied volatility, and one of the things that makes this useful is being able to compare what is the implied volatility versus the realized volatility. I want to make that very clear because I'm not really a strong believer in technical analysis. There's some really fundamental reasons why this works as well. And one of the things that's the most useful about it is that you can kind of use it as expectations, just like you do with news. There's usually a consensus expectation. That's what you should think about the implied volatility as, is this is the consensus expectation about how far we're going to move. And then you can look at how far we actually did move, and that can tell you things about the market. So we actually have a really good example. I have an indicator here, and I have it on TradingView. I know that a lot of you guys don't get VIX data through your regular platform, but here on TradingView, you can see it 10 minutes delayed, and it's really not something that you need to see live. So I will have the link to the indicator in the video description below so that you can add this yourself. But you can see here, this gray line is where we opened. And then I have, the first upside target, downside target, second downside target, etc. Today, we tried to make a move up to the upside target, came a little bit short. Tried to make a move to the downside target, also came a little bit short. So we're seeing that realized volatility is less than implied volatility right now. And that tells us some things about the market, right? Maybe this upside move that we've been having, this strong bull market, is petering out a little bit. Maybe we're moving into a range bound market. There is a little bit less news this week, so that would be a good reason for us to be kind of cooling off. These are all just kind of little data points that we can use to tell us things about how the market is moving compared to where the participants thought it was going to move. If we have a day where we vastly overperform the implied volatility, so I come back here, there was this day, the 19th, where, man, we just really, here's the first target and the second target, and look, we went way further than that. So there was some real stuff going on. you really want to know what is going on. Why was realized volatility so much higher than the implied volatility at the beginning of the day? All right. And just to kind of to give you a little bit better idea of how this performs, I also want to show you this scatter plot that I have in the upper left. So you can see there actually is some randomness to it. Okay. That first target is essentially this red line here. And 60% of days are going to hit the implied volatility target. If you take the 50% of that, so halfway between this first level, then you get this line, and that's 80%. Okay. So you can see, even though there is quite a bit of randomness to, what is the implied versus the realized volatility, there is a little bit of a skew to it. So there's a certain amount of volatility that you can just expect to have based on what the implied volatility is. And you can kind of see that there's kind of tiers, right? There are some days where we perform pretty much exactly what we'd expect, and there are some days that vastly outperform, and there are some days that vastly underperform, and they kind of cluster together. Another thing, though, that I really want to point out is that there's this whole cluster of days down here where, when implied volatility was quite low before we got into this crazy market. And so that's another thing that I think is really important to know, is that this works really well when volatility is picking up. So when you have a day that we're just really moving, then these targets can be really useful to you. Or when you have an environment like we have right now, where just everything is crazy all the time and volatility is really high, then these targets can be useful. So generally, the way that I use it is I say, I have a move. There seems to be some fundamental reasons behind why we're moving where we are. So I should expect to see us to move up into those volatility targets. And you will know, because when you hit that volatility target, there's almost always some crazy action. I think that this is because, again, this is how options are pricing in how far we're going to move. So if we move further than the options we're pricing in, then there's going to be some traders upset about that. And so you're going to have some people stopping out of trades. You're going to have some people hedging. And you see a lot of, activity around it. So these are levels. Again, I don't like technical analysis, so I don't want you to say, oh, well, you said that it would reach the level and you didn't. Don't treat it like that. But it is a level that you want to pay attention to. So I hope that is useful to you guys. You have any questions or comments? I'm sure that a lot of you guys will have insights on this that I, could give us even more information. Let us know in the comments, and I will see you guys when I stream in the morning. In the meantime, stay profitable, friends.